On the 3rd of August, 07, when I got called in for this conference call and saw how bad it was, that evening I decided to take a look at my stock account. And I had previously bought, not too earlier, one of Frank's favorites, the Australian mining company, BHP, is it? Yeah. BHP. And we were in a commodity boom. This is 07. And I noticed that BHP fell like 7% overnight. Now, the question is, how did the U.S. subprime crisis in the Central Valley of California leap from the mortgage market in the United States to Australia, and it leaped from a debt market to an equity market, and it moved from one currency to another? How did it spread out? Well, I kept saying to myself, well, I think I've given this lecture before. I knew what happened. I knew what happened. They were melting down. They were in a meltdown. And it finally, I had to slap myself in the face, because all day long I was listening to portfolio managers managing an institutional portfolio that I had something to do with. And they kept saying, oh, there's nothing wrong with these mortgages. It's just a liquidity problem and no buyers around today. And they were absolutely dead sure of it. And these guys were, quote, experienced. But it occurred to me, that's when I put the two and two together, that we are in a contagion run of all assets across the world, because they got to come up with the collateral. And that was the first meltdown, and it spread to all asset classes everywhere, to every financial institution across the world. The second thing that melted the system down was the minimum regulatory capital, and the securitizing bank or the foreign bank who bought the stuff to hold it. They just bought it for a week. They bought it for 30 years. And what happened is they all have to have minimum capital. And we now have this quick on the trigger revealing losses and quick on the trigger regulatory intervention to seize the keys and show you the door. So what starts to happen is there's not enough capital because the prices have gone down. And the accountants in 07, what horrible timing, market value accounting, when did it go in? November 07, I remember? Is that right? November 07, the whole crisis starts August 07. So by the year end, they had to reveal these losses. Now, of course, I wouldn't want to be the accountant, because you have two twisted arms and a twisted leg and your nose in the vice. But I'm sure they got pressured enormously, and I was really kidding with Jim. How much are they going to really recognize? Because this is post Arthur Andersen, because Arthur Andersen cheated with Enron. So the question is, are they going to do it again? And Jim assured me they would for the right price.
It is a profession.
I'm sorry. All right, well, in any event, what we started to see then is year-end 07 reporting. And if they got to do it with market value accounting, the accountant has to be in a vice and inflicting pain on him. And the more they got revealed, the more capital you had to come up with. And if you didn't come up with the capital, but that's when you start to see Citibank bringing in the the Shaws and the going to the Abu Dhabi. I guess in 07 fall in class I said that next thing you know, Citi will be called Abu Dhabi City or Peking City, because for the first three reporting periods they raised capital successfully from sovereign wealth funds who thought it was a great deal to come in and buy the stock and replace the capital that had melted down and that only lasted about 3 quarters, and they got the idea that this was a bigger, deeper problem than they ever revealed to us. And that's when the foreign capital stopped buying it. Private equity actually took a couple bites of this stuff, got badly damaged, and that's when the private market to replace the capital went away. And thereafter, every reporting quarter, what then has to happen is you're only left with two choices left after that. If you can't get private capital to replace the failed capital, then you got to shrink the bank. Namely, for every dollar of if you have a 10% capital requirement, for every dollar of capital, you can only have $10 of assets. So if your capital gets shrunk down to 50 cents, you got to literally sell half the assets. So now we have more asset sales going on, more selling pressure. Prices continue to fall for this other mechanism, not because loans were getting called, but because they were having to get into regulatory compliance and shrink the bank. And that's a very tricky thing to do. And I'm sure Mylan could give us some really interesting insights into it. But if you think about it, if a bank has to shrink itself because it doesn't have enough capital to support this level of assets, and they start selling the assets, this asset gets sold for cash. So they haven't shrunk the assets. They've just replaced what they have with cash. So they're still out of regulatory compliance. The whole tricky part of this is you got to get the depositors to leave. And that's a depositor decision, not a bank decision. So you somehow got to encourage the depositor to take the money out of the bank. Now, you could do this in a couple ways, and I'm sure a banker like Mylan can tell us. One obvious way is to lower the interest rate. So if you have a bank that's paying 0.01 on your money market account, you can understand they're trying to get rid of you, and they're trying to get rid of you because they don't have the assets. That's the way to do it, and I guess there are other ways to do it. Cut back service and hours and all kinds of stuff like that. Raise overdraft service fees, all kinds of stuff. So, and that's happening in America. That's exactly what's happening. We're in shrinkage. You know shrinkage is happening because they're paying less for the deposits and charging fees, and you go back to exercise your credit line, they say it's disappeared or the price is doubled. Now, if you're lucky, they just doubled the price. So basically, they're trying to discourage any more assets by raising the interest rate, and they're trying to discourage any more deposits by lowering the interest rate. So you find banks with huge spreads, you know they got a problem. But anyway, the third part of the crush down of the financial industry was not only the margin calls, where anyone who had short-term capital wanted their money back, or the regulator saying you don't have enough capital, so you got to sell assets. But the third one is a lot of these assets that were valued on the books of these securitizing banks and the foreign and the holders. And by the way, some of the holders were not foreign. Some of them were domestic as well. Like local banks didn't do the securitization, but they wanted to hold the mortgages. And actually, I think I have that as a separate graph. But the point is, what also happened is a lot of this AAA and AA rating was the result of the credit guarantee of AIG and others like it. And it very quickly became revealed in a phone call to the Fed on a Friday afternoon, I think October 2008, that you better lend us $80 billion because we got a big problem here. And the Fed reflexively said, are you kidding? You're an insurance company. We only lend to member banks. And in this emergency to iBanks that we don't like doing. And they said, no, you got to come in here. We got to tell you something. And what they told them, this is true. This happened over the weekend. Ben Bernanke got his basic education in modern finance. He as much as said so last Sunday on 60 Minutes. What he found out is that they had written $2.6 trillion of guarantees, and the whole basis of the AAA rating was their guarantee. And they had no reserves against it. None. None. And so the whole thing was a fiction. And here's the point: if that gets revealed, and if AIG goes into default and receivership themselves, the guarantee behind $2.6 trillion of bank assets goes away, and now the rating goes down to D, and the price goes to 0.01, 1 cent per 100. So basically, AIG was supporting the accounting fiction that these assets were worth something. And I guess they, in a way, became worth something because every quarter AIG calls up the Fed and extend. And I think they're, at this point, $180 billion into the Fed. And the Fed owns 80%. They should own 99%, not 80%. But that's another story. But the point is, the third thing happened that crumbled the system is all the guarantees went away. AIG got backstop, but a lot of the other financial guarantors did not. Herman, who would be? MBIA, some others. In other words, some of the guarantors were specifically mortgage guarantors, but they were small time by comparison to AIG. So those are the three things that caused the whole thing to cause the the massive selling of assets or the write-down. By the way, there's another thing that caused the write-down of the market value. Not only did the guarantees go away, but the ratings changed. And once the rating changes, you also have an impact on the market price. And I was told by one market participant, I'd like to confirm that with him again, what he told me over the weekend, and it didn't register until he was gone. I got to ask him about it again. I think what he told me was that every derivative of every kind of security of this era every tranche has been downgraded. And because Standard & Poor's and Moody's are getting ready for the major legal fight for their life, because the litigation is about to come and the litigation expense. And so far, they've never lost the litigation, and that's another question as to who can go after them for what. And that's going to be very interesting. By the way, and for those lawyers among us, and I know there are some who are interested in this subject from the legal perspective, I thought this was so interesting and cute the other day. About a week ago, it was either Standard & Poor's or Moody's said, we're not going to fight these lawsuits on the merits. We're going to go to a First Amendment defense, i.e. freedom of information, freedom of speech. Freedom of speech. In other words, what they said is, newspapers can have editorial opinions about anything and publish it. We're just like newspapers. We have an opinion about the creditworthiness, and we're going to publish it. And we have the same protection that newspapers have. There was no fraud. Or if there was, we were protected by, the First Amendment of the Constitution. So basically, they've given up any sense of fighting it on the merits. And actually, in a way, they have to do this because the legal cost. One time I was an expert witness for, I think, S&P on a downgrade that resulted in a default of a AAA. And they're frantic about these lawsuits because it's very costly to them. And if you think about it, they're only paid a fee for an opinion. And that's not a big fee. If, on the other hand, if you say this thing is AAA and it goes into default and then they sue you for the shortfall of value, you're a guarantor, but you haven't charged guarantor fees. It's kind of like at McCombs. Let me give you this great, I thought of this great analogy. At McCombs, we have students come in, they pay tuition, and if they do well, we give them an exam. We give them the BBA, and they go out in the job market, and an employer employs them, and they do terribly. And then the employer sues us because they bought this employee on the basis of our certification of quality. And they sue us for all his mistakes. In that case, we can't just be charging tuition to pay, the lights and the salary and the lecturer. We got to now have an insurance fee fund set aside. So it's the same thing. Once you put them in a position, and by the way, the same thing, there's an awful lot of the blame game going to the mortgage brokers of you knew these people could never pay and blah, 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 blah. But they're not a guarantor. They're a provider of information and product. And if you want to buy it, you buy it. So in any event, that is a gray area that's going to get, and by the way, it did go to the Supreme Court not too long ago with Enron securities. And as long as you provide the information, you're okay. But it strikes me that given the level of over-the-top losses that the pressure on the Supreme Court would cause them to look at it differently. Usually, when this kind of thing happens, you put the company to bed, right? You put them out of business. The stockholders take the loss. The golden parachute goes away. What we've had to do is keep the system together because the cost to you and I as a taxpayer, putting them under by doing it, this is a systemic run. It's every bank. And if we want to pay the shortfall of liquidating every bank, it would be a fee to us as taxpayers that would probably exceed what we would get in deposit insurance coverage. It'd be a net loss to us. So we've kept these people in place, and kind of one by one they get what's the word? They're about to replace the Citibank president. So they get sideways with a few of them, but they haven't. There was no penalty paid yet, because basically they're government employees at this point.